6. This is our live Facebook chat. I'm going to get Arnell Brady at Brady Always Be Closing to join us. Okay, he's on here. Let me see if I can get him to join. Okay. Okay, he's popping on. We're waiting. You're in business. Gotta turn it the other way. Gotta turn it the other way.
I gotta turn it the other way?
Yeah, the sideways. Yeah, there we go. Okay, pull it up. Yeah, you go. All right. Hey, Shanita. I see Shanita Inc. join. Hi, everybody. Say hi as you're joining in.
Yeah, people are coming in. This is wonderful.
Hey, Shanita. So, I just give a little caveat. Arnell and I have known each other since literally I was born.
Yeah. Long time.
So when we talked recently, we just knew we had to do something like this because a lot of my viewers have asked questions about home buying programs and mortgages, and even clients that I've had, some of their financial goals are to buy a home in the future. So I definitely wanted to do a live chat during this financial literacy month, and here in Chicago, Money Smart Week, to chat about the mortgage process and real estate finance. So we'll just jump right in. Like I said before, I'm Tamara Durbin with Money Basics. I'm a financial coach and educator, and my goal really is for my individuals and couple clients to create a plan for them to reach their financial goals. So we actually sit down, create financial goals, create an action plan to achieve those goals, and then help monitor and track the accomplishment and achievement of those goals. I also do financial workshops for churches, organizations on a myriad of financial topics. So, Arnell, tell them a little bit about yourself.
Sure, yeah. Brady Always Be Closing. Arnell Brady, the Federal Savings Bank. Been in mortgage probably about 5 years. Financial services going on 7 years. Work for just about all the major banks. And now I'm at a federally chartered bank. We're a veteran-owned bank, doing a lot of good things in all 50 states. So I have clients in Texas. I have clients all the way in California as well as my home base is really here in Chicago, helping people achieve the American dream of home ownership and, most importantly, creating wealth for their families. So I definitely want to thank T. Durbin for inviting me to be a part of this Money Basics.
I'm glad to have you. So we're gonna in this chat, please put your questions. If you have questions, put them in the chat because we can answer them live too. But we do have some topics and the discussions that I wanted to pick Arnell's brain about today. So we'll start with how do you know, especially like when I work with clients, how do you know as the banker that a person is financially ready to purchase a home or purchase an investment property?
That's an excellent question. I'll start with the home buyer. I mean, one of the first questions I always ask a client is, how much do you pay in rent now? And this is, to our first time home buyers, we just want to really get a gauge from a banker perspective. Is your rent going to be comparable with what your estimated mortgage payment is going to be? So really the first question to my clients is, well, what are you actually paying for rent now? Because once we have that component of what they pay for rent and we start to estimate what they can afford, we decide, does this math work? Is it worth it for you right now to actually, purchase, or are you more comfortable financially with your situation and paying rent? So we really look at that because it's not just what can I afford, but it's more importantly, like, how can this fit within my next 3 to 5 years? You know, does it make sense to exhaust your down payment funds when you only plan on being in Chicago for 2 years and then you plan to move? So it's about calculating, does this make sense, and doing the math. So that's really where we start when we work with like a first-time home buyer and an investor. You know, how long do you plan on keeping your funds to build capital in this vehicle? You know, we look at the cost. So I call that phase counting the cost.
Right.
Is it worth it?
And that's, just so you guys know, that's one of the reasons why when I talked to Arnell about this, that I like even his value system and how he approached his clients, because that's one of the things that I sit down and map out with my clients, is looking at their financial goals and seeing what fits. I always talk to them about what fits within your scheme, what fits within your financial plan long term, within your short term, long term goals, and if that opportunity fits, hey, let's go for it.
Yeah, that's right. We got Vince out there watching. Hey, Vince.
Hi, Vince. Hi. So, okay, this is a burning question a lot of people have when they're nervous. Like they want a home, but they're nervous to even go to the mortgage banker to actually submit their application because they don't know what you're looking for. So can you tell us a little bit about what, as a mortgage banker, what are you looking for when a client comes to actually apply for a loan?
Right. Good. Man, that's an excellent question. You are the money basics. I see. You got all the good questions here. No, but first thing we're going to do is just kind of, get a picture of where they are now, pre-purchase, do you have some assets saved, checking and savings? How much cash on hand do you have? It's important that we talk about that. So we call that, we can call that assets. What type of assets do you have? One of the other important things are a credit score. We want to make sure that clients have a credit score that will be acceptable for them, not only to be approved, but I always tell my clients, let's try to overachieve. Why don't you get a credit score to where you have now a vast variety of options with regard to programs, with regard to your interest rate. So credit score.
Please say that again. Like you want the best interest rate.
That's right.
You want to pay less. You want to pay less. That's how the rich get richer. They pay less.
See, money basic. I like that. So, but that's critical. What's your credit score? We want 620 and above. I always tell my clients the sweet spot is probably 680 to 850. That's really where you want to be. 680 gets you in the ball game to now start choosing a better rate, as well as some of the top-notch programs on the conventional side. It allows you to just have more options and flexibility with your program and your product. Another thing is your credit. How is your credit history? Not just your credit score, but have you had any bankruptcies within the last, say, 4 years? Have you had any foreclosures in the last 7 years? So credit history is another thing that we're looking at. And then lastly, income. Everybody's afraid of debt to income ratio.
Yeah.
Rightfully so, because we are looking at that. But I'll be honest, there are several programs that I get clients into every day where we can go as high as 55% debt to income ratio. So the 45 traditional has now expanded, and that 10% really makes a big difference. So we can go up to 55%. I would always recommend for clients just to Google, how do you calculate debt to income ratio? That way you can come in really armed when we're prepared to have our conversation.
Okay. Now, let me ask you this. So I have a couple clients where, let's say it's a couple, and let's say one buyer is stronger than the other. Mm-hmm. How do you recommend or counsel a couple where, as far from a credit perspective, they're still putting, all their money into one pot, so they technically have the income to afford the mortgage and it fits within their budget. However, from a credit perspective, they really don't want, like you, the mortgage banker, to include that other spouse in the approval process.
Right. Right, absolutely. So in those cases, and I have clients do that all the time, we usually sit down for what I call mortgage 102. This is like mortgage 101, what we're doing right now, but mortgage 102 is allowing for, situations where people are married. Does it make sense to share this debt right now if one person can actually afford it on their own? Because what you can do is free up the other person's income to maybe buy the investment property, where we're not counting the old house the house that they live in right now, but they have two separate income streams. Use them to what they can be allocated for. Meaning, why put, if the debt to income ratio is say 25% combined, and we get to go up to 55. Why would you share a $300,000 mortgage when one person can just be on the note, two people can be on the deed? That way you both own it in case anything funny happens down the line. But, so I really look at their goals.
So that's possible.
Yeah, absolutely. We don't have to put both people on. But at the same time, like to your question, if both people are actually want to be on the loan and we need them, we're actually looking at them individually to be on this same loan. That means if one person's credit score is below the threshold, then we actually will not be able to put them on the loan as a co-borrower. So it's important that both people are strong. One can be stronger than the other, but we'll still end up taking the lower credit score of the two.
Right. I think that's important for people to know coming into you. Now, I have a friend actually asked me this question because I have a couple friends that are self-employed.
Oh, my favorite.
That's a new thing now. Especially with, I think a lot of millennials too. A lot of people have even online businesses now. But I have a couple friends that are self-employed, and they're thinking about purchasing a home, but they're worried about how do they determine my income, because it's, it can be irregular, but then also just documentation of the income. So can you speak to first of all, the importance of documentation of the income as a self-employed buyer, but how do you qualify for a mortgage as a self-employed individual?
Sure. Self-employed is actually my favorite. That's my strong suit, self-employed. But that's a good question. I want to tag this answer, pay your taxes. Okay? That's how I'm going to... Pay to play.
Okay. Yeah. I like that. Pay to play.
Right, that's right. Pay to play. So if clients come to me, they want a mortgage, and I've had many clients that come one day, we don't qualify them for actually another year or so, just based on the way they claim their taxes. For example, if you have a client, he's self-employed, he does construction, he's a general contractor. We're going to approach that. We're going to look at their gross, what they made. Let's say they made $100,000. But then I scroll all the way down to the bottom of their tax return and look at what their adjusted gross income is. So for 2016, let's say it was 50,000 was their adjusted gross. 100,000 was their gross. We're going to look at their 2017, if it was the same, 100,000 gross, 50,000 adjusted gross. We're going to take those, add it together, and then we're going to divide that by 24 months. That is the way we come up with their gross monthly amount, which goes right back into that debt to income ratio. So a lot of times what I will see is clients that will come and they'll say, Arnell, I made 100,000 last year. Then when I scroll down to the adjusted gross income, I see 15,000. Seriously.
Right.
And I say,
they need to get the income down so you don't have to pay as much as
I get it. But that's why this one is called pay to play. Pay your taxes. And I just recommend, when you know you want to purchase, make sure you pay to play. Pay your taxes, claim that income so that I can use it. And then maybe after you purchase your house, you can go back to trying to recoup some of that tax amount. But you want to be prepared when you come to the mortgage banker. Have your taxes in order.
So they need to have 2 years of good tax return.
2 years of good tax returns. There are some special programs and circumstances where we'll take 1 year if you have experience in that field. For example, if you are a truck driver, per se, and you're self-employed and you just went from a W-2 income to now you own your own truck, if you have 1 year of taxes, we'll actually look at that situation. So as a general rule, 2 and 2, 2 years of tax returns, 2 years of self-employed business returns, if it may be. And we're going to average that, the adjusted gross income, both years added together, divided by 24, and bam. That's how we come up with that debt to income ratio.
That's good. That's good. Because I have even, I think about people even in the beauty industry, hairstylists, barbers, where they a really huge cash business and they take a lot of cash, but they don't document it and track it so that when they are ready to buy a home, they have documentation of the income that they've made. And then, of course, from a tax perspective, we want to write everything off to get that number down. So I'm glad that you spoke to that, pay to play. I like that. I really like that. Pay to play.
Tag that.
I always tell my clients, pay to play. You got to pay to play to make these goals happen. Hey.
Pay to play. Play to play.
So can you describe and tell us a little bit about, I know people, once they, decide they want to get a home and they get into the mortgage process, they really don't understand, once they give you that application, what the mortgage process looks like and kind of how long it takes from the time that they find their dream property to the time that they can actually close with underwriting and everything. Can you tell us a little bit about what the mortgage process is and how long it generally takes?
Sure. At the Federal Savings Bank, we actually do closings on purchases within 30 days.
Okay.
We have a very fast process. I actually just love it because my clients, which I call realtors, are my clients. They just love putting their clients in the Federal Savings Bank because our I call it manufacturing process is so fast. Because there's several different entities that are going to actually touch your mortgage throughout the process. I remember when I was at the big banks, the majors, it would take maybe 45 to 60 days to close a purchase. And that's just because of the way they have their manufacturing process. But at the Federal Savings Bank, I actually have a product called the Express Loan. It's a little different than the general process, but I'm actually pre-approving my clients with all of their documentation up front. Okay. And in certain cases, we'll actually send that through underwriting while they're searching for a house. Okay.
Ooh, okay. So simultaneously, it's going through that process.
Simultaneously, it's going through that process. The normal process is you pre-approve me, I pull your credit, you have A1 credit, I look at your income, you're qualified for $350. When you find that house, that's when we're going to start to send your loan through the process. We're going to send it through operations so that they can send it through an underwriter. At the same time, you're getting your inspection. You're also making sure that you stay in your attorney review period so that the attorney can look at the contract, look at the inspection at the same time, feel like this is a good deal. The next step of the process, like I stated, is underwriting and us ordering an appraisal. As a bank, we want to ensure that the house you're purchasing is worth it to us to make the investment to loan you the money. So they're ordering that appraisal. Once the appraisal comes back and we know that's fine, your loan comes out of underwriting, you don't have any conditions. It's just third-party verifications that we're getting, like verifying your job. We are, checking with your insurance agent to make sure that you have accurate insurance for this new purchase. Once we take care of all of that, we're sending your loan for final underwriting, and we're also making sure the title is clear. Once those items are all clear, your loan comes back out of underwriting as clear to close, and then the two attorneys will set up your closing date. That process, like I said, at a major bank will take anywhere from 45 to 60 days. At the Federal Savings Bank, we're closing loans all purchased in 30 days, and we stand by our word. It's just because our manufacturing process is
See, Brady always be closing. That's why he always be closing 30 days.
I like that.
Now, let me ask you this question. You're doing the whole verification process, especially like the income. How is that process different for self-employed borrowers?
It's actually the same.
Okay.
We're taking those tax returns, and that's what's major about self-employed. We're really going by the tax returns. Now, if you're a W-2 employee, we're just checking to make sure you're still employed. You know, we're looking at your pay stub to make sure that your year-to-date matches up with what you made last year. So it's some checks and balances in there. But it's really easy if you're W-2 employed. Sometimes we don't even need tax returns when you have W-2 salary income. So the process is pretty smooth. Self-employed, I would tell people not to be afraid of that. If you have your I's dotted and your T's crossed, it could be just as easy, to get a loan these days. Yeah, it's not that difficult.
Okay. So you talked about how you guys can close. You have a product where you close in 30 days. Tell me a little about, sometimes I have people, and there may be some people on watching that may be first-time home buyers, and you hear people talking about different first-time home buyer programs or programs that offer even down payment assistance. Do you guys have any programs like that?
Sure. Yeah, we have several programs. We have national programs. We have state programs that we have. And, I want to say this, first-time home buyer, that term is really synonymous with just the traditional buyer today. I'll be really honest about that. Because the first thing a client will say is, what type of first-time home buyer stuff do you have? Really, money. That's all. That's what kind of money you got. That's straight to the chase.
You want to help get that down payment, just getting in the door.
There you go. Right. So, but honestly, there are several programs. Let's just say I have 6 first-time home buyer programs. Right. Most of them, I'll say at least half of them, you don't have to be a first-time home buyer. And by definition, a first-time home buyer to us is really somebody who has not owned a property or been on title or deed to a property within the last 3 years.
Okay, so you'll have start over.
Absolutely. So you'll have somebody that bought 10 years ago, sold the place, and they'll come to me and I say, "Oh, you're a first-time home buyer." They get mad because I'm not a first-time home buyer.
Look, I don't care. You call me whatever you want to call me if you're gonna give me some money.
That's right. Give me the money. That's right. That's right. So we have several programs. We have a program called the Chicago Infrastructure Trust, where they're giving you up to 7% of the purchase price towards closing. Now,
wow.
Yeah, it's a wonderful program. You must be purchasing in the city of Chicago in order to get that. We have a program called the Federal Home Loan Bank, where they're giving you $4,500. Now, that's a national program that we have. Okay. So that's a good one. We also have IDA. IDA is a program where in Illinois, if you're a first-time home buyer, there are also options for non-first-time home buyer, but it's usually $7,500 that they're giving you. There is an option, too, for 10%, but it's repayable. The $7,500 is a forgivable grant.
Oh, wow.
Yeah, so that's a wonderful program. So we have several, first-time home buyer programs, several. And I would encourage everybody to always ask your realtor or a mortgage banker, what options are out there for you. First-time home buyer or non-first-time home buyer. Don't pass up the money.
Okay. Now, are there any special income limits or purchase price limits typically on the first-time home buyer or the down payment assistance programs?
Good question. They are. And they vary from program to program, so you will want to get with your licensed or registered mortgage officer so they can give you the specifics on that, because it is different. It is different for each person.
I think you told us about everything, but are there any special programs that maybe you didn't mention that maybe specific to the Federal Savings Bank that you guys have that is kind of like the hot program that no one knows about? And this could be not just first-time home buyer, but investment property that is kind of like the well-kept secret over there.
Well-kept secret, right. We do have one. Let me reach in this drawer and pull it out. Let me make sure nobody, is listening. Oh, that's right. This is Instagram, so everybody's listening. No, so we do have this program. It's called TFSB 100. It is a 100% financed program. The borrower needs their closing costs. So that is a wonderful program. It's nationwide. For a lot of people, the down payment is their downfall, holding them back from actually qualifying for a home. So this program is here to fill the gap. It's a nationwide program. Once again, I said it's 100% financing. FHA and conventional, they have a 3% down and a 3.5% down. This program is 100%, no down payment. It's similar to like a VA loan where they don't have to put anything down. So that's just a wonderful program. For more information, people can go on my Instagram, Brady Always Be Closing. I'm pretty sure I posted something on there, and they can come and get that. I'll make sure that Money is Basic posts that program on there as well.
Yes, I will. So you spoke about VA loans and other typical conventional loans. Can you speak to typically, if you don't do the 100% financing, what does a typical down payment look like? Is it 3% now? Because I know at one time when the market crashed, you had to have at least 20%. But I think now there are more programs coming back. So is typically the minimum 3% or 5%?
Sure.
Or 10%?
Yeah, actually, that's a great question. So with FHA, it's 3.5%.
Okay.
They've kind of been steady, pre-bubble and post-bubble. 3.5% on FHA has been the thing. With VA, it's 100%. They don't have a down payment on that. Now with conventional, you remember conventional was the 20%. If you didn't have 20% back in the day, you were going FHA 3.5%.
Okay.
Conventional has walked its way all the way down to 5% now. Okay. And then they do have this program called Home Ready, which people can reach out for more details, where they will allow you, if you have a certain credit score, to do 3% down on a single family home. So that's wonderful, Yeah. Mortgage insurance is cheaper on those products, so it's out there, yeah.
Because that was I was thinking about, because the big thing with the 20%, you just kind of said it, the 20% versus like the 3 or 5 is PMI. So typically, do you have any or do you have to pay PMI with? Because I know sometimes people have programs where is it FHA or one of them that you don't have to pay PMI with the program, or is it 10%?
Well, so there's a jumbo mortgage out there where, if you put a certain amount down, and jumbo is any loan that's really in this area over $453,100. Okay. If you put like 10% down, 15%, there is no mortgage insurance. Traditionally, 20%, no mortgage insurance. However, there's what's called lender-paid mortgage insurance, where you're taking a higher interest rate. Okay. So they're getting the money.
They're factoring it in, yeah.
They're factoring it in. However, you do not have the monthly mortgage insurance in that case. Oh. Yeah.
Now, I know that the Federal Reserve Bank has, been toying with interest rates. What are we looking at right now about interest rates?
So, interest rates. Yeah, absolutely. Interest rates have really been playing yo-yo for a while. For example, I'll just hypothetically talk about Ida, for example. Last year, around this time, I was quoting like 4.375 to 4.5, on FHA and conventional products.
Which is low.
That's really low. FHA was like about an 1/8 to a 1/4 point lower. Well, I just checked like yesterday, and they had went back up to, let's say, 5.5%. 5.5% equal FHA and conventional. So they're like, it doesn't matter which one you do.
Where are you going?
And what we're seeing is a lot of market compression right now. We're really seeing them squeeze the margins that banks are profiting on. They're really squeezing that, and the rates are really stuck in this high point right now. We're getting a little relief over the last couple of days, just because of market fluctuation, but I don't see them going back down to the 4.375.
So you're thinking that if you're thinking about buying,
now is the time.
Now is the time.
Now is the time, as well as inventory. I mean, oh my God, inventory is at an all-time low right now. You have a lot of people that are just really hurting looking for properties. We have all these pre-qualified buyers. You know, my pipeline is full of people that are just pre-approved because they can't find a home. You have multiple offers on every property.
Wow.
I haven't seen that in a while.
Wow, so this is a seller's market.
This is a seller's market. They're out there having fun.
Okay, so speaking about sellers, how is the underwriting process or just even the application process different for those looking to invest? We talked about kind of position home, but if you're looking to actually invest in a property, as an income producing property or even a rehab, and maybe those two aren't simultaneous because I guess you could do a rehab even if it's your home, is the process for underwriting or the programs different for those types of properties?
Sure. So I'll just say with investors, from that standpoint, the purchase process is really different because we're really scrutinizing your assets as well as your credit score. Now it's more skin in the game. It's more risky of a product for us to actually give you a loan on somewhere where you don't reside, you don't lay your head. We're also looking to make sure that you have some rental income history. Now, that's not a qualifier, but it makes us at ease when you have some rental income and you're buying your first 4 unit, for example. However, we do have first-time home buyers buying 4 units, which is a smart way to gain some income and set yourself up for future wealth when you do that as a first-time purchase as opposed to like a single-family home. But to answer the question, yes, the loan-to-values are typically lower, meaning that we want you to have more skin in the game. Credit scores are generally a little higher. Because we want you to be stabilized and not have a derogatory credit. From a rehab standpoint, the process is different because, normally, like I just mentioned in the other process, towards the, a 4th to 2/4 range, we're ordering the appraisal. On a rehab project, we're actually looking at the scope of work that you have up front to make sure that the place will appraise. You see?
Okay.
If you have more due diligence, more of a checklist to actually do in the beginning, so that we can make sure the proposed work that you want to accomplish is gonna pan out value-wise.
So it sounds like if you're doing a project, whether it's even your home or even an income property and it's a rehab, you probably need to enlist a contractor up front to kind of see how much it's going to cost you to do whatever work you need to be done on the home.
Absolutely. I would always recommend, getting a professional involved to give you an estimate, just because there's a lot of unforeseen things when it comes to repairs that you might not know about. And that could really mess your deal up, especially on this product. This is my bread and butter, the 203K loan. You have a lot of people that say, I found a property, Brady, and it's $50,000. I want to put 100 in. And that's where, whenever you hear that, like, I got a property, it's 50, and I want to put 100 in, it sounds like they just want to take the 100,000, dump it into the property. So I make them break that down, line item by line item. What do you actually want to accomplish, so that we can see if it's feasible for the loan type that you want to do.
Are they looking at for a rehab property?
Right. Now, if they're looking for a rehab property, it's the same thing. What I'm really talking to my clients about is make sure, especially in a low inventory market, meaning there's not that many homes on the market that are already finished. So I'm really advising clients, let's find you something that you can rehab and you can take advantage of some equity. It might take longer to get into the property, but the rehab property is the way to go. We're doing that due diligence up front, making sure that the purchase price, the estimated repairs will equal the after repair value that we need to get the property done. Okay,
and you can still put the five, those same programs apply, the 5%, 3%.
Yeah. With FHA, the 203K loan, it's 3.5% down. So that's just wonderful, and that's on a 1 to 4 unit. With conventional, it's on a stair-step system. The higher you go in units, the more you need to have skin in the game. But yes, you can do that on rehab properties, and it's just a wonderful vehicle right now.
Okay. Now, those of you online, if you have any questions, just pop those questions in the comment area. If you have any questions about qualifying, about, like we just talked about, the down payments, the interest rates, we have Brady always be closing. He's the one that can get you closed. Financing
right. 30
closed.
days. Say the tag, 30 days or less.
That's 30 days or less. I want to thank you for taking this time out. I know it was hard to get him pinned down because he's always closed and always working, doing workshops for Money Smart Week and Financial Literacy Month. So I'm glad that he could work this into this schedule to give us these pointers and just talk about real estate finance and the mortgage process, the products that his has, and the things that he can do to help you get into those properties that you want to get into, whether you are buying a home for yourself, you're thinking about investing in real estate, like we just talked about, even if you're thinking about doing a property and it's a rehab property, because, you know, we watch HGTV. Okay, we have a question. Can a person get a loan in one state to rehab a house in a different state?
Sure, absolutely. Most rehab loans, if you're living in one state, that means that you're